Hello everybody, welcome to another update on the stock screener. Today we're going to compare Verde Agritech with Karnalyte resources because I get a lot of questions on how Karnalyte resources is such a good company and I should take a look at it. So I'm going to take a look at it right now. So here you have Verde Agritech has gone up tenfold over the 5 years. And here you have Karnalyte resources gone up maybe fivefold from the dip here. So let's compare these two companies. So I have created a PowerPoint for this. Verde Agritech vs Karnalyte resources. So let's compare the metrics first. We have a company with 370 million market cap versus a smaller company, 25 million. Okay. So based on this alone, I would choose the one with a higher market cap because it is more established. Then we have mine life. Karnalyte has double the mine life of the Agritech. So at first sight, that's a good thing. I like companies with a lot of mine life. So the next one is CAPEX. To get the company fully built, you need CAPEX, and the CAPEX for Verde Agritech is around 400 million. And for Karnalyte resources, to get all the phases built, it's around 2 billion. So this is already a red flag for me. 2 billion versus only 400 million. Okay. Next, we look at the NPV of the full project at spot potash prices. And for Verde Agritech, it's 14 billion, and for Karnalyte, it's 12 billion. So it's comparable. Current earnings, Verde already has earnings, and it's about 100 million per year, and it's rapidly rising. Karnalyte has nothing, okay, zero earnings. AISC in potash equivalent, Verde has pretty high costs, around 250 to 300 for potash equivalent. Karnalyte is a cheaper project, so that's a good thing. Then we have production. Verde produces double the amount of Karnalyte resources at full capacity. Then we have the construction periods. Verde is already producing, so it's already in phase 1 going to phase 2, and soon it will be going to phase 3 in a few years. So I see Verde Agritech as a producing company. Karnalyte is not producing yet, and it will take about 2 years to build the mine for the first phase. And they've already talked about this since 2016. So we are now 6 years later, and they are still not in production. So I'm not sure if Karnalyte will ever be in production. So that's another red flag. Now let's take a look at the EBITDA valuation. As you know, we always use production times the price minus the costs times 5. So we have all the numbers here. And for Verde, it's 19 billion EBITDA valuation. For Karnalyte, it's 7 billion. Okay. So based on this, you can calculate EBITDA to market cap. And for Verde, it's a possible 50 bagger. For Karnalyte, it should be a 300 bagger. So everything looks fine here on the EBITDA to market cap metric, but not so fast we have other metrics to discuss here. So what's very important when you look at NPVs, you need to normalize this. So what's normalizing? So let's say we have a company that has 20-year mine life, 1 to 20. And the NPV rises. So each year it rises because cash flow is coming in. So it starts from 10 and then goes to, for example, 200 million market cap. 200 million book value. So that's how the company is earning money. Now, of course, you don't give the company already 200 million in value because it takes 20 years of time to get to the 200 million. So how do I give this company the real value? We normalize it to 5 years. And why 5 years? So let's say this is 20 years and you go to 5 years, that's divided by 4. So this 200 NPV divide by 4 gives us 50. So this is the value that I would give for the company right now if it starts production. And why? Why do I give this 50 in value? Because if it goes up by 15% per year, which is a very good return, this is a normal return for a shareholder, 15% per year, then it will go up like this. 15, so 50 to 58 is 15%, and you keep adding this linearly. So that's it's like a dividend of 15% per year. Then this market cap will rise like this, and eventually it will go to the 200. Okay, that's why I like to normalize the NPV to 5 years, from 20 to 5 years. So you can also do this for a company with 70 years, like Karnalyte Resources has 70 years of mine life. And for example, at the end of the 70 years, we have 700 NPV. How do we normalize from 70 to 5 years? You divide it by 13, okay? So you divide this by 13, and then we get to the 5 years, and we get from 700 NPV, we go to 50. And when you add 20% return every year, then it rises like this. And at the end of the 70 years, we will get to the 700 million end result. So for Karnalyte, we need to divide the NPV by 13 because Karnalyte has 70 years mine life. So let's do that. Let's normalize the NPV 14 to 5 years. So for a 36-year mine life, you would divide by around 6.5 to 7, and then you get 2 billion normalized NPV. For Karnalyte, from 70 years to 5 is divided by around 14. So this divided by 14 is 860 million normalized NPV. So this gives another picture already. So the normalized NPV is higher with Verde Agritech. So that's the first thing. You normalize the NPV, and then we need to compare this with the CAPEX. So how much NPV value do you get for a given CAPEX? And this ratio is the normalized NPV divided by CAPEX, and it should be higher than 1. So you want low CAPEX giving a high NPV, normalized NPV, okay? And when we do this, we get the following. So we had the normalized NPV, and we divided by the CAPEX, which is 400 million for Verde and 2 billion for Karnalyte. So we divide the 2 billion by the 400 million, and that gives us a ratio of 5. So 5, it's pretty good. It's above 1. So for a low CAPEX, you get a lot of NPV. You get 5 times the normalized NPV. Very good project. Gold mines probably have around 2 of this ratio. Some have 1 ratio. So this Verde Agritech project is really good because it gives 5. Karnalyte, however, as you can see here, if you divide the 860 million by the CAPEX of 2 billion, then you get a CAPEX ratio of below 1. This is a bad project. Why? Because you need to have a lot of CAPEX to get a normalized NPV of which is lower than the CAPEX, 860 million. So this is not a good project based on the CAPEX requirements. Then we have the other ratio, which is the market cap to CAPEX ratio. And this gives us the likelihood of dilution. Will there be dilution? So we want to have a market cap that's higher than the CAPEX, because then there's less risk of dilution to the shareholders. So what's the ratio here for Verde? It's around 1, okay? They have a 370 million in market cap and 400 million in CAPEX. So that's around 1. And they also get 100 million net earnings per year. So I don't see a lot of dilution risk here because they have earnings. However, Karnalyte Resources, if you divide market cap of 25 million by the 2 billion in CAPEX, then you have a minuscule market cap to CAPEX ratio. This is highly dilutive. Highly dilutive. So as a shareholder, you do not want to hold this company because you will need to pay a lot of money to get this project going. And that's also why this company is never going to get built. Okay, and this one will get built. It's already producing. So here you can see these are the red flags and these are the green flags. Okay, so in conclusion, when I compare these two companies, Verde has better CAPEX ratio compared to Karnalyte Resources. And Verde is already producing with cash flow. Okay, so that's another risk that is lower than Karnalyte. And Verde has low dilution risk due to the low CAPEX and also because they are already cash flowing. So in conclusion, no, Karnalyte Resources is not better than Verde Agritech. Just stick with Verde Agritech and you will be better off, okay? And I'll see you in the next video.